Well, I can see the screen. So basically, how can investors protect themselves in a syndication? Again, the disclaimer, um, don't just invest based on what I tell you here tonight. This is provided for information, educational, entertainment purposes. Please always consult with your professional advisor when contemplating investments and understand their associated risks. And we're going to talk about what some of those risks are in this presentation. What we're going to cover real quick, just a couple of easy, quick definitions. The difference between investing in the stock market and real estate. There's no direct correlation there, but we're going to talk about how we can look at that. Sources and uses of funds, so that as an investor, why is your money being collected and what's it going to be used for? For those of you who are still new to syndication and learning from the GP side, this will be informative as well. A quick overview of what the syndication process is, what are some of the risks with multifamily investing, and then really the 5 big questions that every limited partner should be asking the general partnership. So with that, let's get started. So what is syndication? You know, it's this big fancy term out there that we throw around in real estate and other ways, but really it's just the pulling together of equity capital from multiple individuals or legal entities to invest in real estate with the intent of generating a profit or a return on that investment. And a syndicator is the person who basically initiates and puts that whole thing together. Now, they'll find the property, they'll bring the investors together, they'll attract the investors, and they'll purchase the property, and then they'll ensure that the rewards or the return on the investment is delivered to the investor. One thing to be certain of, or in a question I get a lot, is what is a cap rate? A cap rate is used in the world of commercial real estate to indicate what the rate of return that you can expect to be generated on a real estate investment property if you pay all cash. Not if you're going to use a loan or other kinds of things, and it doesn't take into account improvements to the property after the fact. This is if you buy it today, based on the cash flow today, that's what the cap rate is. And it's expressed as a ratio, a percentage. And basically you take the net operating income and divide it by the purchase price, and that's your cap rate. So with that said, how do you compare stock market versus real estate? It's hard to, because there's a big history with the stock market on how much of a return the stock market can generate over time. But in real estate, it's really property specific. It's hard to generalize what overall average returns are for real estate so that you can compare that directly to the stock market. So I took a look at what are some of the main categories as an investor into a real estate syndication that you would want to be concerned about. And let's talk about from both the real estate and the stock market perspective. All right, so you've got income. Is real estate, yes, it provides income or provides passive income. And if you're a passive investor, that's what you're looking for. The stock market can also provide passive income, especially through dividends. Is there any tax advantages? In real estate, yes, you've got the advantage of depreciation. In the stock market, not so much. You will have a hit on taxes when it comes to capital gains when you sell. You also see some capital gains in real estate, but you can offset those capital gains with depreciation. Income and other gains can be offset with depreciation. You don't see that in the stock market. Inflation hedge, real estate is a good inflation hedge. Usually as inflation goes up, so does wages generally, not always, but generally. So then rents can go up and compensate, and it tends to be a good hedge on inflation when you invest in multifamily real estate. Stocks, not so much. Stocks go up for other reasons, not necessarily strictly due to inflation. So it's not necessarily a good inflation hedge. As far as leverage, can you leverage in real estate? Yes. And there's a lot of advantages. You can do a high amount of leverage, which means getting a loan to buy the property. In commercial real estate, you can get loans. Right now in the market, you're seeing 75 or 80% loan to purchase price. And those loans can come in as non-recourse, which means that if the property goes bad and the bank has to take it back, they don't necessarily come after the borrower personally. The property is the compensation to the bank for that. And if you use leverage, if you use debt to buy properties, you get a higher return for your invested dollar than you would over on the stock market side. If you're looking to buy $1 million property in real estate at a 75% return, you only have to put up 25,000 or what is it, $250,000. If you want to buy $1 million in stock, you got to put up $1 million, unless you're using margin. So while there is potentially some leverage in the stock market, it's awfully high risk, and they have rules on how much you can use margin to buy stocks over there. And the other advantage is in real estate, if everything goes to hell in a handbasket, the property is all you can lose. On the stock market side, they'll come after everything you've got, including things outside of your investment account. So appreciation, how do you see appreciation in real estate? Yes, you can both control your appreciation and you can see appreciation through mortgage pay down. We call that controlled appreciation, forced appreciation. That's where you improve the property so you can raise the rents or reduce expenses or both and increase the value of the property. You don't get a chance to see that kind of appreciation in the stock market. Now, real estate is not all roses and sunshine. It is an illiquid investment, which typically means that there's not a ready market. You can't sell out your real estate immediately, especially if you're buying as a limited partner into a syndication. They may allow you the ability to sell. I've seen some syndications that don't allow you to sell at all, but there's not a quick and ready market like there is in the stock market, which is highly liquid. If you want to buy GM stock today and sell it tomorrow, you can. And there's people out there who can make that happen in a matter of seconds. Returns in the real estate market, they can be high. Of course, with any investment, they can be low too. But the returns are based on two things: cash flow and appreciation. And we talked about appreciation already. But the property, if operated properly, the income would be more than the expenses. And by the time you pay off your mortgage, there should be additional cash flow left over to distribute to your investors. And as a limited partner, you want to make sure that cash flow is there, because that's part of your compensation for investing in the property. There is some returns on the stock market side, but it's lower. If you buy dividend paying stocks, you'll see those returns. Otherwise, the only returns you can get is if you see the market value of your stock go up. And we're going to talk a little bit more about that here shortly. Volatility, real estate is low volatility. If you wonder what volatility is, the value going up and down, real estate is a longer cycle market. Property values don't jump up and down 20, 30, 40, 50% overnight, or even within an hour. They do in the stock market. The volatility in the stock market can be very high. And there's even a volatility index that measures, how volatile the stock market is at any given point in time. Diversification, real estate's not real big on diversification. You can do it, but it's got to be spread across different properties and different property classes over time. It's easier to diversify in stocks, especially if you are investing in a fund. They may have 300-400 stocks in their fund, and you're already diversified just investing in a fund. So if you're looking for diversification, stock market is probably better than real estate. Fees are low on both investments, and we'll talk a little bit more about that. Really, the only cost to the investor in real estate is the wire transfer fee when you send your money into the general partnership to buy the property. There are other fees that are involved in real estate transactions, but the returns to you are calculated after all those fees are paid. So you know what you're getting net, not as opposed to before fees. The stock market, it used to be that for your brokerage account, you'd pay all kinds of fees. You'd pay fees for each transaction that you conduct, every time you buy or sell. And, they used to fee you to death there. They've reduced a lot of those fees now. So I'm going to classify the stock market as low on fees as well, especially if you have one of those online accounts and they can do, a couple dollars a trade or something like that nowadays. I don't know how low they've gone, but now if you're looking for tax advantage retirement accounts, you can do it in real estate. You can do it in stocks. I think it's easier for stocks. There's some additional tax implications if you use your retirement account to invest in real estate that is using debt as part of the ability to purchase. So let's just say the stock market has a better advantage on tax advantage retirement accounts than real estate does. Now, control, here's the big thing. If you're going to compare real estate versus the stock market, you have ownership in a brick and mortar building. The general partnership sets an operating budget, and they manage a professional third-party property management company to execute to that budget and operational plan. On the stock market side, you have no control over what the company underneath that stock does, unless you're Warren Buffett and you can buy a significant portion of their outstanding stock and sort of force them to do things the way you want. I don't know if any of you are in that boat. If you are, let me know. Let's have a conversation afterwards. But I'm certainly not in that boat. Market makers control the market for stocks. Political factors, economic factors can affect the value of a stock. I have seen companies have tremendous earnings statements or earning calls, make a lot of money, and watch their stock value go down within minutes of the end of the earning call for reasons outside of their control. So even the company and how they operate don't necessarily control the value of their stocks in the open market. And you see things like emotional or panic selling and market disruptions. Like, let's say a market disruption would be what happened to the taxi industry when Uber and Lyft came out, right? It decimated taxi businesses across the country. So there are things out there that if you're buying into stocks, you really don't have control, whereas there's a lot more control in the ownership of real estate. And that control extends to then ensuring the return on investment that you have. It's easier to do that in real estate than it is in the stock market. Now let's take a look at the stock market, because you're going to hear all the time, well, the stock market returns, I don't know, somewhere between 6 and 8% every, over time, over 50 or 100 years, or whatever the answer is. I didn't look at it over 50 or 100 years, but what you're looking at here is an average from January 1, 2000 to the end of December this past year. The top one does not adjust for inflation. The bottom one does adjust for inflation. It does include dividends. And the average return over those, 20 or 21 years. I always get confused when they throw the extra 2000 on there. I think that adds an extra year. So we're looking at 21 years here. The average return in the stock market was 8.19%. And then the actual compounded annual growth rate, though, is only just a little over 6.5%. When you adjust that for inflation, the average return goes down to 5.9% and 4.4% for the compounded annual growth rate. 21 years in the stock market, for some of the best years we've seen, 18% last year, almost 32% the year before. And you can see some of those numbers here going back through 2009. And this is all the stock market actually returns. And this is before they charge you their fees. So really, these numbers would go down a little bit more. Now, if you're looking at a real estate investment that's offering you 12, 15, 18% average annual return, this is your comparison then to the stock market. But you have to do, with real estate, you have to do it on a property by property basis, because there's no two properties can be compared together to where you can say, on average, overall real estate provides this level of return. People try to do that using REIT values, REIT stock values, but those are subject to the open market, just like the stock market is, because you buy them in the stock market. So it's really hard to use REITs as a justification and comparison against the stock market. Cap rates, we mentioned that in the beginning. How do you, what is a cap rate? It's a net operating income divided by the purchase price. The notional cap rates that a lot of people a number of years ago used to look at is, this is the best class of property, A, middle of the road, blue collar working, and then I didn't include on here class D, which is war zone kind of properties. So I didn't even consider those. But these are the kind of cap rates that back in the mid 2000 teens, maybe a little earlier, you could see in primary markets are like large cities, New York, San Francisco, Philadelphia, other big markets, Washington, D.C. Secondary markets would be suburbs and some of the smaller cities like Cleveland, Columbus, Ohio. Those can be considered secondary markets. And then tertiary markets are really smaller areas from 100 to maybe 400,000 or 500,000 people in the area. And you can see as you go from primary areas and high-end properties to smaller areas and lower end properties, the cap rate changes quite a bit on a notional distribution. As of October of this last year, I have not updated it since the end of October. This is what we were seeing in our markets at that point in time. So much lower than what you're seeing here. We've seen over the last 10 or 12 years a compression of cap rates. They've been going down and down, which means property values are getting greater and greater. And in fact, these numbers are even probably a little too high. I was looking at a C-class property in a C-class neighborhood in Tampa a month ago, and they were quoting me a 4.4% cap rate on a C property that was going to need a lot of upgrade. So depending on what area you're in, what market you're looking at, you're going to see even lower numbers than this. So properties are expensive right now. I don't know that they're going to go much lower. Cap rates are going to go much lower, but we'll see. Time will tell. As Daryl said earlier, interest rates are going up. That's going to put some upward pressure on cap rates potentially, and we may see the value of some of these properties starting to fall as interest rates push further up. But they're still at historic lows, so it may be a while yet before we see a big impact. So the syndication process. What does a syndicator do? Okay, there's a number of jobs that the syndication team does, and really, there's sometimes they're called sponsors, sometimes they're called the general partnership, sometimes they're called the syndicator, but it can consist of one or more people who do the following activities. One, you got to fund the due diligence. You got to come up with the earnest money deposit. Once you sign the purchase and sale agreement, typically 1% of the purchase price is put up as a deposit, earnest money deposit. Then the partnership has to pay for inspections and go to the property and do the proper due diligence and the walkthrough of the property, pay for other people to do inspections of different aspects of the property. They've got legal fees involved with the SEC and or contract attorneys. And for larger deals, we're talking, 100, 200, 300 unit deals. This number could be in the hundreds of thousands of dollars just to get through this point here. If you're looking at a $20 million property, 1% is what, $20,000? Is it 20,000, I guess? Yeah. Or $200,000 actually on a $20 million property. Earnest money alone is $200,000 plus these other fees. They also have to find the deal. They have to develop the broker relationships. They have to underwrite the deals, submit the LOIs, get financing from the banks, and that's a big one. And then oversee and get through closing. And there's a lot of headaches going through all of those processes. But those are things that the general partnership does, and that's how they earn their money. One of the general partnership one or more people have to actually sign for the loan with the bank, which means that either collectively or individually, they have to have a net worth equal to the loan balance at closing. And they must have liquidity equal to 10% of the loan balance in general. And that may be up to the bank. And there must be, if they're looking especially for agency loans, they must already have some multifamily experience. So for those of you who are looking to get involved in commercial multifamily and you don't have this here and you're looking to use loans as a means to purchase property, that means you need to be looking for teammates who can bring to you this kind of capability. And for those of you who are looking to invest on the limited partner side, you want to know that this person here is strong enough to be able to carry the loan and that there's not going to be issues, once they take over the property from a financial performance perspective. The general partnership also does investor relations. You as a limited partner are going to want to be communicated with on a regular basis as to how the property is doing. And if something bad happens, and something bad will happen, you want to be told about it and you want to know what the plan is to fix it or remedy the issue. And whether it's a fire or a murder or who knows what, right? Pipes break, somewhere, loss of income to whatever extent. You want to know that they have the ability to understand the problem and solve that quickly so that the property can go back to operating the way it was intended.
Dennis, can I ask a question?
Sure.
So with respect to the sponsors or guarantors, the individuals who do the signing, this can be multiple people? Is there a limit as to how many people can be on that?
I don't know if there's a limit. Yes, it can be multiple people.
Okay. So the sum total of those individuals need to meet the second rules criteria. Okay.
Yes.
Second and third. Mm-hmm.
Yeah. Raphael, have you seen anything out there where there's been more than 2 or 3 co-signers on a loan?
Most I've seen is 4.
Okay. Yeah, I don't know how the banks would look at, if you try to do 5, 6, or 7 of them.
Well, all they care about is if you have a $10 million loan, they want to make sure that the signers have a total of about $14 million in assets.
Yeah.
So
Dennis,
Yeah.
on there were 6 on my loan.
6 on your loan? Okay.
Yeah, there were 6 of us.
That was the Augusta property?
Yeah.
Okay.
Yeah.
So you can go up to 6 at least now that I'm aware of that. So that's good.
Yeah, I know of a GP team. There's like 9 or 11 people on the team, but I think they limited it to like 5 or 6 that were on the loan, signing on the loan.
Okay.
Yeah, they all have to go through the equivalent of a deep dive by the bank to make sure that their financial situation is as represented. So now, 2 things. As a general partner, you're collecting money, you need to know what it's going to be used for. And as a limited partner, you want to know how your money is being used. So let's use this example where we have a purchase price on a property of $5.36 million. The down payment is $1.34 million. This is a 25% down payment, so 75% loan to value. So they're getting a 75% loan. They're anticipating doing capital improvements of $290,000, 3% acquisition fee, 3% in closing costs approximately. The bank is charging points for the loan. I think this is 1 point. The bank also wants insurance and taxes in reserve, another $78,000. And then another additional capital reserves because of COVID. We have what us GP people call the COVID tax imposed by agency lenders of 1 year principal and interest payments. It's just going to sit in the bank, and hopefully after the end of the first year, if you operate the property well, they'll give you that money back. So this gives you a total acquisition cost that the general partnership has to raise from limited partners. And then as a limited partner, you also want to make sure that the general partnerships are invested along with you. So any money they're going to raise is going to be less their co-investment on the limited partner side. So they're buying into the limited partnership as well here. So the total raise in this example would be 2.19 or basically $2.2 million. Now the returns to the investor are going to be net of all these fees that are going to be quoted. If they're not, you need to understand that up front, because usually any of the fees are either built into the operational numbers of the property or are net of these fees at closing. And all this is closing costs. So they need roughly $2.2 million to close on this property.
Mm-hmm.
So what else does a syndicator do? That's not all. They've got to manage the property, which means they got to manage the property manager. It's not enough to put in a property manager and walk away and think things are going to operate just fine, because they don't. If you don't manage them on a weekly basis and on a monthly basis, you're going to find the performance of your property is going to decline over time, sometimes quickly, sometimes a little more slowly, but it will decline. So the asset manager, the GP, has to be on top of that on an ongoing basis. And these are some of the activities they have to do. And then at the end, they've got to either refi or sell the property to return the investors money and to give them the returns that were promised in the beginning. So all of that is what a syndicator does. From a limited partner perspective, now you know this. And so you can start asking questions and understanding what some of their issues are going to be. And you want to know that they've already started to consider a bunch of this kind of stuff, and you want to know how they're going to operate. And if the answers don't make sense to you, dig further or walk away. Now, how does a syndicator get paid? You should know that as an LP as well. This is a notional, what they call waterfall for the equity split. This is just within the general partnership. If it's just one person, they get all of this. But typically, general partnerships have multiple people or multiple organizations involved. And so you're going to see that they're going to take some of these tasks and they're going to assign a percentage of their equity split to that task. So the person doing the due diligence might see 5% of the general partnership equity. If you're doing the acquisition management, 20. The loan sponsor somewhere between 5 and 20%. It really shouldn't be much higher than that. People raising money and investor relations up to as high as 35%. I've seen it lower, and I've seen this go a little higher. And then the ongoing asset management piece, maybe 20 to 35% on that as well, because that's an ongoing issue and it involves travel. Now, what does all this come out of though? Typically in a syndication, right now, most average syndications are either 30% split with the GP, 70% going to the limited partners, or a 25-75 split. 25 to the GP and 75 to the limited partners. So all of this is built into this 30% or this 25%. It doesn't touch what the limited partners would get, depending on how that is set up in the PPM and the operating agreement for the general partnership on this property. So with that involved, what are the risks in multifamily? So now you have a generalized understanding of what syndicators do and what are some of the terms involved. So what are some of the multifamily risks? Things to keep in mind as a limited partner investor. And I call it the multifamily folklore, okay? You're gonna hear a lot of generic kind of statements and you really wanna question those statements because I hear them from different syndicators that I talk to over time. Millennials are the godsend to landlords nowadays. They're always going to stay in the urban core. They're always going to want to rent. They're never going to want to own. You'll hear multifamily always does well in a recession. Well, we'll talk about that in a minute. Occupancy projections are high because people have to live somewhere. Well, it's true they have to live somewhere. It just doesn't have to be in your property. Concessions, we're going to have no concessions on a property. Well, maybe. And cap rates are going to stay the same. When I go to sell in 5 or 10 years, the cap rate's going to be what I bought it at or even lower. Not so fast. And if you hear those kinds of things, you want to ask more questions. Let's take a look. Home ownership since 2018 has increased 2 to 3%, especially as the cost of renting has encroached ever faster on the cost of home ownership. Even though home prices are going up, rents are going up enough that it's starting to make that equation level out for the millennials. And a lot of them now are starting to question why continue to rent if I can build equity in a home ownership. And we're seeing that number continue to grow through 2020, especially now since the pandemic. Millennials will stay in the urban core of large cities. Not true, according to what happened in 2020 with the pandemic. We saw people leave San Francisco, Manhattan, and other large cities in a significant amount. We saw some vacancy rates you wouldn't believe in those cities, and we'll talk about that in a minute. And also, people are living in the city for a number of reasons. One, especially, was to be close to work, but with more work from home, it means the freedom that they can live anywhere and still work. And multifamily doesn't always do well in a recession and the other. And here's a couple of cities that we just picked up. Since 2016, we've already started to see the growth rates for these large cities go on the decline, and they've continued to decline, even though you're still seeing some growth. The growth has gone down from as high as 2% in Dallas down to almost 0. In San Francisco, from a high of about 1.6, 1.7, down to below 0.5. And in New York and Chicago, the growth rate has actually gone negative. Millennials are not necessarily staying in the urban core. They're going to the suburbs or even further out. So the idea that millennials are going to stay in the urban core is not true. And this was true. This was happening even before the pandemic. The pandemic just accelerated that some. Multifamily always does well in a recession. No, it doesn't. During the Great Recession after 2008, Atlanta saw cap rates decompress. They went from 4.5% up to 6.1, almost a full 2% increase, which means a lot of properties lost a lot of value in that time frame. Vacancy rates in Manhattan went over 10% in 2020. They went greater than 20% in San Francisco in 2020. And Freddie Mac, which is one of the agencies that supports a lot of the commercial multifamily loans, says that rent growth is really taking a dive. They expect average vacancy to rise from what they're seeing nationwide before the pandemic of something in the 4 to almost 5% range. They expect it to go up to 7.2%, almost a 3% increase in vacancy, which is going to have an impact on the bottom line of a lot of properties. And they expect to see rent growth slow because of that. You know, people are forecasting 3, 4, and 5% rent growth, but Freddie Mac is saying, look, it's going to be less than 2%. So something to pay attention to. How are your syndicators evaluating their property, and what numbers are they using to forecast? As a limited partner, you want to understand that, because they may be giving you too rosy of a picture. In fact, and concessions are rising. I talked about concessions will be almost zero. We had one new Class A, or I guess here in Philly, they call them Class AA or Class AAA properties, came to market in late 2020, and they wound up offering between 1 and 4%, 1 and 4 months free rent just to fill the building. I mean, talk about concessions, 25% rent concession in that property. That's amazing. And those concessions are not just happening here in Philadelphia, but they're happening around the country in a number of the key markets. And we're still seeing, we thought we'd see a larger decline in rent collections than we did due to COVID, but with the government helping with all the programs they put in place for renters, we maintain a higher rent collection than we thought, but still, as of March 6, 2021, rent collections on a national average were only at 80%. That number will go up as you go through the end of the month, but still, we're not seeing as high of a rent collection as we did pre-pandemic time. Now, vacancy versus recessions. If you look at the last 3 recessions that we've had, the dot-com bubble in 2000, we saw vacancies go from just over 3% up to over 7% in a matter of 2 years as a result of that recession. The housing bubble in 2007 and 8, we saw vacancies jump up to 8%. And we're starting to see, as I mentioned earlier, San Francisco, New York, and a bunch of other cities, we're seeing vacancies, achieve some terrific numbers. When you start looking at 10, 15, 20, 24% vacancy numbers, that's pretty impressive. And I will say that's not true nationally, but it depends on the market you're in. You've got to ask those questions for your, as a limited partnership investor, you have to ask those questions of your general partnership and really understand what their assumptions are, because it's not always true. When you factor in increase in vacancy, an increase in concessions, a reduction in rent, you start adding all that together, you see a significant impact on the financial performance of a property, and they may not be able to deliver anywhere close to the returns that they tell you they're going to deliver. And in fact, if you go back to my YouTube channel, we did a session just on this alone, and we showed that with just a few tweaks to those numbers, a property can lose 40% in value in a very short period of time. So is that normal? No. However, you as an investor want to make sure that your general partnership, your syndicator, is understanding those issues and has plans in place to try to address that.
Do you find those or verify those trends just kind of like by publicly available information? Are there any particular resources you use?
Well, actually, that's how I did it. Calculatedriskblog.com for this chart.
Mm-hmm.
This is William Fry analysis from the U.S. Census Bureau. Metropolitan Policy Program at Brookings. If I go to this next slide here, Newmark Knight Frank, which is a real estate firm. Okay. Their research based in 2020. This is about concessions increasing. And we've seen concessions in the past have been higher. If you go back to the 2008, financial crisis and reset, what they called the Great Recession, I guess, we saw concessions go from what, average of about 6% up into double digits, 9%, and in some cases, up into 10 or 11%. We've seen a long decline in concessions over time because we've had the biggest run in, one of the best runs in real estate we've ever seen, a very elongated real estate cycle. But we're starting to see an uptick. And it started even before the pandemic hit, if you notice here. It leveled out and it started to increase in 2019. Then once we got into 2020, you really started seeing concessions go up. And I talked about some of those. So these are all charts that I've got through doing internet searches to find this data. So this is not stuff that I've made up. I'm not sure I'm creative enough to make this kind of stuff up, but it's there to be seen and had. Same rate with cap rates. Cap rates are not always going to continue to go down. They can only go so far. People need to make money on their investments. But what we did see is as between 2008 and 2009, as the market slowed down, cap rates went up, which means the property lost values. The higher the cap rate, the lower the value of the property. And the average cap rate is this top line here. Where's my arrow? Went up to about 7.5%, which is pretty high. And through 2014, it was down here. But this was just after a recession. You see the cap rates go up, resulting from a recession. So we're starting to see a little bit of that. Not as much as we were hoping, but you're starting to see a little bit of that in some of those metropolitan areas that saw a significant outflow of renters, a reduction in rents, and increase in concessions. So if you know what markets to go cherry pick at, you can get higher cap rates today than you could have this time last year. So the big, why only 5 questions? Really, you as a limited partner investor, you want to know that you're a good fit with the syndicator or the syndication team. And these 5 questions are important to determining that in your mind and or in their mind. It's got to be a good fit for both sides. If their approach is not aligned with your approach for investing, then maybe that's not the right fit for you. Because you're going to find that each syndicator has their own unique investment philosophy. Some look for high returns, and that means there's a higher risk involved. And then there are others that are more conservative in their approach and would rather provide lower returns in exchange for lower risk. So if you're someone who's looking to double your investment in a short period of time, then a 5 or 10 year hold is not for you. But if you're someone who's more conservative in your approach and you're really more concerned about protecting your money than you are necessarily on return on your investment, you're more concerned with return of your investment instead of return on. You want both, but then maybe a longer term hold and a more conservative approach is best for you. But the only way you're going to know that is to ask your syndicator that you're considering investing with. So why only 5? There's lots of questions you can ask. But a lot of those questions are going to be addressed in the private placement memorandum. Most investors invest with people that they know, that they like, and that they trust. And it is a relationship business. I'm going through an exercise now raising money for a property, and I'm finding that the investors are investing based on the people that they're talking to, not necessarily, the returns are important, but it's more important. What's more important is the relationship they have with the people they're dealing with in the general partnership. So one of the key questions to ask is for details on their experience and their background. And this applies to all the team members. How many units do they have? Have you done this before? What are the education credentials? Where'd they learn about multifamily? How many years have they been syndicating? How many deals have they done? Additionally, find out how many assets that they've acquired, or how many have they sold in the past? What have been their results, right? Have they delivered on all their promises to their investors? If they didn't, why not? What did they learn? The more experience these people have, the more confidence you can have that they can deliver on the things that they're telling you. 2, do they have skin in the game? You need to assess if their interests are closely aligned with yours. Now, what does skin in the game mean? Most people think it means I'm invested alongside of you as part of the LP. And that's one way to have skin in the game. But don't forget, they're also signing on the loan. They're also fronting all the different costs to buy the property. They may be offering you, the limited partner, preferred returns so that you get paid before they get a dime. And then you look at their compensation as well. You know, does it seem to be in line with norms, or is it way out of line? I saw one syndication where they were charging an outrageous sum for legal fees. So there was something funny going on there that caused a lot of investors to pull back. And those are the kind of things you want to understand. So is there skin in the game, and how is there skin in the game? And is that all right with you? How much do you need to invest? How much is the cost of entry, right? What is the timeline? When do they need the money? And how long is your money going to be in the investment? And that goes back to, you know, is it 18 months? Is it 5 years? Is it 10 years? And are you okay with that? Everyone wants to know that what their return is going to be, but I find mostly investors are worried more about the safety of their money and the exit strategy equally as the return they're going to make on that money. So, you know, sometimes that can't be pinned down. This one deal I'm working on now, you know, they're at a 10-year hold, but they have the right to sell before that if the market conditions allow them to meet all the promises that they're making to their investors. So you want to know that there's a little flexibility there built into how they're going to operate the property, just in case. Ask the syndicator why they like the deal. What is it they like about it? You know, it's beyond just having skin in the game. You know, why this area? You know, is there population growth, job growth, rent growth? What are the economic conditions going on? You know, as far as appreciation, does a rising tide lift all boats? It usually does. You know, how about the cash flow on the property? You know, understand what their assumptions are. And we talked about some of those already with regards to concessions and rents and cap rate at the sale date as opposed to cap rate at the purchase date. Make sure that they're just not making guesses. Make sure they put some thought into it, and they've been able to convince you that there's been a process behind their assumptions so that they're grounded in something other than just a guess. And don't let enthusiasm replace sound judgment when investing. Some people can be real salesmen. You know, so you want to make sure you cut through the salesy part of it and get into, is this really right for you? What's your sound judgment? What's your financial advisor going to say? You know, if you use one. So one question most people fail to ask is, what happens if you go away? You know, if something does happen to the person putting the deal together, or the key principal in the general partnership, you know, what happens next? Well, if that's me, are you going to send me flowers and condolences or what? But you know, what's the continuity plan? Who's going to take their place? What's going to happen to the operation if something were to happen to some of the partners or one of the partners? You need to know, if you're bringing money into an opportunity, you need to know how they plan for the unexpected. So know the main risks. In summary, basically, know the main risks in multifamily investments. Ask questions of the syndication. That's the best way that you can protect yourself in a syndication, is to be knowledgeable enough and to ask questions. Read all the documents that they have to provide. The SEC says that they have to, if they're going to syndicate, that they've got to do a certain number of things. And part of that is generating a private placement memorandum, operating agreements, subscription agreements, and some other documents. You want to review all of those. Hidden in there are going to be all the little details. And so take a little bit of no-dos, read through the legalese, and understand what they're actually offering. Consult with your lawyer, your CPA, your financial professional to determine if it's right for you. And I always like to understand, you know, if they're going to syndicate, they must register with the SEC. How they register, one of these 3 ways, is going to dictate how they can raise money. And each of these has different requirements and limits on how much they can raise and who can participate. So you want to make sure that you're dealing with the right kind of registration so that they're not improperly getting someone into the investment that shouldn't be there. I believe that's all I have for tonight. Oh, if you want some additional frequently asked questions, I've got a list here. I can, this will be out there on recording on my YouTube channel, but I can also send this to you if you want it later.